And welcome to today's webinar, where we're going to be looking at all things buying and investing abroad. And I'm joined today by some brilliant experts who are going to help me answer many questions that have been submitted in advance. However, we have got the chat facility if you haven't already asked a question and there is something that you would like to cover off, and we'll do our best to get to those in the chat as well. However, we have been inundated with questions. Clearly, investing and potentially buying abroad is clearly a hot topic at the moment. We've got a huge number of people attending and submitting questions, which is brilliant. So I do apologise in advance if we don't get to each and every single individual question. But the good news is that post-event, you will get everybody on this call's details to follow up with on a one-to-one basis to cover off any questions that you've still got outstanding. So this this webinar will be recorded, and we'll send through the recording to each of you as well afterwards so that you can watch it back. Of course, the advice that we're going to discuss here will be reasonably general, not knowing the intricacies of each individual on the call, and so we do recommend that you do follow up with the experts on a one-to-one basis to make sure that you get the best advice for your individual circumstances. Of course, it's going to be reasonably general on this call without doing a deep dive into your own details. But here we go. So I'm Nikki Stevenson, the MD at Fine & Country, and so I work closely with real estate agents all across the globe. And I'm joined today by Jonathan, who is a property expert, as it says on his screen. He is a non-exec director at Fine & Country, but also an agent on the ground dealing with UK property. So great to have you on the call with me as well, John. We've got Stuart, who is an expert in all things visas. So I'm sure we're definitely going to drill into some of the information that Stuart's got to share with us today. We've also got Chris, from covering off all things global mortgages, debt and lending. So again, really key topic that we want to cover off. And we've got Matthew from Lumon Finance, International Currency Exchange, and Jake. And I think pretty much 80% of our questions were relating to tax. So I'm sure we'll be hearing a lot from Jake. So quick overview, but John, I'll start with you. Give us a bit more detail in terms of your background.
Thank you, Nikki. Welcome to everybody that's joined us on the call, and also the co-panelists, a lot of which I've done one of these with you before, so they're always interesting. My background predominantly is property, real estate, over 25 years experience, and the majority of that's been working in what we call the upper quartile. So it's the prime part of the market, the top 25%. So I've worked with Fine & Country practically since its inception. So I've seen all sorts of markets. I've seen highs, lows, dips. You can kind of recognise the signs. I also work really closely with the Bank of England, helping to pass on data. I've got a meeting with them next week, actually, which will be interesting, and always get a little bit of an insight back from them. So hopefully we might see a rate drop in the not too distant future. But yeah, I'm here to help as your property expert and to answer any questions relating to either buying or selling.
Excellent, thank you. We've got a good few questions for you lined up. And Stuart, over to you for an intro.
Good afternoon, everyone. It's an absolute pleasure to be here. So thank you to Fine & Country for having me and my fellow panelists. So I am the managing partner of Henley & Partners UK. Who are Henley & Partners? We are the global leaders in citizenship and residency planning. What's that in simple layman's terms? It's allowing someone to invest in another jurisdiction in order to obtain a residence or citizenship. I personally have been with Henley & Partners 9.5 years, approaching my decade for my sins. But yes, we are the people who will enable you to spend as much time in said country or where you're looking to invest. We are the guys who will enable you to spend as much time in that country as you wish to do so.
Excellent, thank you. And Chris, over to you.
Hello everyone, thank you very much for joining. My name is Chris Lloyd. I'm head of private clients at NS. I've been with NS for just over a decade, and we are your absolute go-tos for anything debt related on a global scale, whether you're looking to move to the UK, buy in the UK, or leave the UK and invest elsewhere. We can typically get lending in the UK or most jurisdictions in the world, and we can look to drill down, and I'll show you a little bit more of some examples around that. But yes, we are very good at arranging complex lending situations, so that whether that's your main residence, buy to let, second home, or even aside from just residential property, we can look at semi-commercial, commercial assets, and then aside from property as a whole, we can look at luxury asset finance, so lending against artwork, luxury cars, watch collections, anything up to a yacht. So yeah, very versatile in our lending offering, and yeah, look forward to speaking with you in a bit more detail.
Brilliant, thank you, Chris. And Jake, over to you.
Yeah, hello everyone. My name's Jake Barber. I'm the owner of SJB Global. So we're a cross-border financial planning company specialising in helping UK and US expats all around the world. So with the cross-border part, it's very much focusing on how we can structure things in the most tax-efficient way, which is a lot of the questions that have been asked are surrounding this sort of thing, which is what we specialise in. So whether that's your pension or retirement accounts, investment accounts, looking at your domestic country and the country where you're living, and just making sure that we structure things in the correct way. It is very complicated and very complex, so our job is to try and simplify things as much as possible, and hopefully by the end of it, just make sure that you have the peace of mind that everything is structured in the right way. We're regulated across the world, so we've got UK regulations, US regulations. We're regulated in Cyprus, which covers all of Europe, and then we're also regulated in Gibraltar, which covers the rest of the world where there isn't really as strict regulations. And set the business up 8 years ago, and we've got more than $350 million under management at the moment, and growing very fast. So yeah, looking forward to running through some of the questions that have been asked.
Excellent, you sound like a good person to know. And over to you, Matthew.
Thanks, Nikki, and thank you everyone for joining. My name is Matthew McClure. I'm one of the senior traders at Lumon Pay. We're a currency exchange brokerage based out of Farringdon in London. We've been in business for over 25 years. I've been here personally almost 6 years now, typically just assisting with clients moving large volume transfers internationally for property purchases, property sales, international investment, and plenty of other reasons. I've been here through the COVID period, the end of one Trump campaign and the beginning of another. As well as the Liz Truss debacle in the UK too. So plenty of experience in volatile markets. But at Lumon, really the aim here is to undercut a bank's exchange rate with our own competitive rates, as well as offer an expert service to assist clients in timing their currency requirements and ultimately help them save money.
Brilliant. Okay, well, we've got some really experienced individuals on the call, which is great. So Stuart, I'm going to start with you because quite a few of the questions that have come in, I guess as a, I suppose, opener as well, is where should I be looking to potentially move to? Where should I be looking to invest in? What country is the best place to go to? There's all sorts of, I suppose, things going on around people, millionaires, and lots of people moving to Dubai, and other people are looking at European hotspots. But where is the best place to go? And I'm sure this needs to be drilled into on a more individual basis. But I know you've got quite a bit of data that might start to paint a picture of where some of the hotspots are.
Absolutely, yeah. So we can never answer it on we can answer it on a general level. We can't actually give advice on for every single person. We would need to speak to that individual, understand their own specific financial profile. But if I report back on the trends that we saw in 2025, I think you've already hit on it, Nikki. The vast majority of the clients that we serviced last year from the UK, whether that be an actual British person or a non-dom sat in the UK, the vast majority are going to the UAE. They're obtaining residence in the UAE. If we go aside from that, and actually the UAE was, given the figures that we launched earlier in 2025, where we predicted the vast majority of the wealth leaving the UK, we also predicted where they were going to go, and it transpired that the vast majority are going to the UAE. We have also serviced a lot of people who wanted to claw back their EU status. Brexit happened. A lot of people weren't happy with that. They had bought their house in the Algarve, or they bought their place in Marbella, or etc., and they wanted to spend as much time there as they wanted. Brexit happened and they couldn't do it. So we had a lot of clients who were obtaining EU residency via investing in real estate, or actually using the asset that they'd already purchased as the mechanism to get them that EU residency back. So Portugal and Spain were very popular in 2024, 2025. Spain has actually ended their golden visa program. Greece has materialized as a high contender. There's lots of people who are, sorry, there's a lot of feedback from something. Sorry, I'm getting lots of feedback. There was Greece and Italy. Italy were wise to the fact that they were going to see a significant increase in interest in Italy. And so the government there decided to increase their flat rate tax from 100,000 to 200,000, and now there's talk of 300,000, because they knew that lots of people were going there as well. So on a general level, the UAE by far and away #1. Portugal, Italy, Greece, Switzerland, Cyprus as probably the backups. Spain was incredibly popular, but it no longer exists as a golden visa option now.
Brilliant, that's a really good overview. And I know you specialise in obviously helping people get into these different countries, and I know that there's a difference between residence and citizenship. Do you want to just give us an overview of what that looks like and how both apply?
Absolutely, yes. So there are residence by investment. So we at Henley & Partners deal with residence by investment and citizenship by investment, which is investment migration as a whole. Now, obtaining a residence by investment enables you to make an economic contribution to said jurisdiction, and that will enable that person to spend as much time in that country as required. A citizenship by investment program, of which there are decreasing amounts, usually now replaced by citizenship by merit. But if we look as a general level, the Caribbean has always been a popular option. You invest in real estate in the Caribbean, or you make a donation and you go straight to passport. That is for people who want to effectively upgrade their passport or have an alternative passport. We've even got Brits who are doing that now. It remains a popular option for people who want an additional citizenship. So residence gives you the ability to reside in that country. Citizenship by investment effectively gives you a passport to that jurisdiction. That affords you all the same rights as a passport. You can live in that jurisdiction, but residency is limited to the residents.
Okay, and how many different programs are there across the globe for this?
Yes, so round about 100 nations offer a residence or citizenship program of some variety. We at Henley & Partners deal with programs we feel comfortable with, that feel as though add value and that make commercial sense for all involved. Now, we offer about 60 programs across the globe, and I'm just looking at my map on my wall now, and they range from Canada, the US, Panama, Costa Rica, across to Europe, where we have the vast majority of the European programs, Greece, Cyprus, Portugal, Italy, Switzerland, the UK. Not many people coming to the UK now, but there are still out there. Then we have the Caribbean, of course, back over there. Then we have Malaysia, Australia, New Zealand, Hong Kong, etc. So, and obviously the UAE as well.
Yeah. And typically, what's the sort of costs involved with getting residency or citizenship in another country?
Yeah, so each program is government driven, government run, and we help the client onboard themselves onto that program. The costs can be as little as a few £1,000s for the likes of the UAE residents by setting up a business, etc. Each of the options that we have, Cyprus has 3 or 4 different options, Greece has 3 or 4 different options, UAE has 3 or 4 different options in terms of obtaining the residence permit. So a few thousand up to 8-9 million euros if you want Austrian citizenship by merit.
Right. Wow.
Something for everybody, I think.
Yeah, exactly. And I know one of the questions that's come up beforehand is, can you just tell us a bit more about investment migration? What exactly is that and how does that work?
Yeah, so it is so you have Mr. Client who wants another residence or citizenship. Now, they may be doing that to relocate, or they may be doing that to hedge their bets. You know, we have people who say to us, I'm scared of what's going on in the UK, or I'm scared of what's happening in the US, or I'm petrified of World War III, etc., etc. They want another residence or citizenship as a backup. Now, historically, about 10% of our clients would have actually used this to relocate. You know, 90% were just doing it as a plan B or a travel tool or an alternative. That number in 2025 changed dramatically. So we've seen a massive uptake in our services from Brits who are actually looking to relocate. They're actually looking to leave the UK and go and spend time elsewhere, like we discussed about the UAE. So investment migration is the actual vehicle in which people use to get there. Because me, as I'm a British passport holder, I've only ever lived in England. Where else can I live? Not many places at all, unless I marry the right girl or get the right job in the jurisdiction in which I wish to go to. Our options are limited. So if something does go wrong in the UK, and historically we've dealt with countries where the risk of that is much higher, if something does go wrong in the UK, where's my get out? I don't actually have one. I can't go anywhere. Yes, you can go somewhere for a small period of time, but residence and citizenship by investment migration as a whole is what enables you to have another residence or citizenship. You make that investment in said jurisdiction, or you make that contribution to the economy in that jurisdiction, and in exchange, that government, that country gives you the passport or the residence in which you are intending to achieve. Excellent. Hopefully that makes it as clear as easy as possible.
Really good, thank you, Stuart. I'll come to John next, or Jonathan. Just so we've heard from Stuart how, you know, he's experiencing people looking to potentially leave the UK. I mean, what trends are you seeing, John, in the UK property market?
Before I answer that, Nikki, can I just go back, Stuart? I'm not sure if my computer glitched when you quoted the entry into Austria. Did you say 9 million euros?
So there's Austria citizenship by merit is a unique offering that we are one of the only people that can offer it. There are two entry points. It's either 3 plus associated costs or 8 plus associated costs. So yeah, wow. Sorry, to answer your question, yes, if you want to invest in Austria to get the citizenship, that is the case. If you want to get just residence in Austria, there's a much more, how shall I say, cost-effective way of achieving that. You don't get the passport. And the Austrian citizenship is the highest ranked passport that one can obtain via the investment migration world completely.
Okay, fair enough. Thought I'd just double check. So sorry. Nikki, going back to your question, what trends are we seeing in the UK property market? At the tail end of last year, we had this standoff between buyers and sellers. There was a hell of a lot of caution around the budget. There was a lot of anticipation in terms of what was going to be introduced, how draconian the measures would be, and the impact that that would have both upon people's businesses, their lives, and as a result, the market stalled. I think the measures that were introduced weren't as bad as many feared. So there is a degree of normality coming back into the market this side of Christmas. That being said, it is still very much a buyer's market. And the things that we're noticing is people aren't just buying with their hearts and their emotions now. They're very much logic driven. So they will spend a lot of time analysing, making sure that what they're buying is sensible, it's the right price, it's got a good chance of holding its value. So I think there are some properties that are sticking, but there are also, there's many anecdotal evidences of properties selling really quickly and some with a fair bit of competition, but they tend to be the ones that are priced sensibly. So yeah, towards the tail end of last year, it was pretty awful. Things started to slip a little bit, definitely up in the upper quartile. This side of Christmas, we've started to see some normality come back in. The UK is still attractive to overseas buyers. So I know we're talking about people buying overseas at the minute and investing outside. However, there's an influx of people coming in from America, which is really interesting. Stuart's nodding his head, so he obviously agrees with that sentiment. And actually sterling is still relatively weak in comparison, which makes it an attractive buying proposition because prices are relatively stable. They're not jumping up astronomically. It's still very much a needs-based market for the normal transaction. So people are making their buying decisions upon work, relocation, schools, access to families. We are also seeing people do the full cycle. So we're definitely second Stuart's opinion that we've seen a lot of people go to the UAE, but we're also seeing quite a few people coming back from the UAE. So they'll go there, they'll make their money, and then they'll come back for whatever reason, through family. They might be having kids and then want a support network around them, and all of a sudden they're coming back, but with deeper pockets than maybe what they left with. So that's another trend that we're seeing. In terms of the expectation as to what's going to happen moving forward, I think it's widely expected, and Matthew might be able to give us more insight on this. I think a base rate drop will come in, which should make borrowing more affordable, and again, that's probably going to stimulate activity a little bit more. So yeah, they're just some of the trends that we're noticing.
Brilliant. And if see the guys on the webinar at the moment, some people may have their property on the market already, some may be thinking of selling in the near future. What would be your best advice to achieving the best possible price and achieving a sale in a reasonable time frame to enable them to move on to the next stage of their life?
Yeah, and another question is, what do you do first? Do you find and then try and sell, or do you sell and then try and find? And people want one foot on the shore before stepping off the boat, and no one's ever quite sure of the right process to follow. I guess the difficulty that you've got is if you see the perfect place and you need to liquidate an asset in order to be able to buy, if you haven't sold, you end up making snap decisions and compromising in a rush and a panic in order to be able to secure something that you want. So I would also always, I'd tentatively look, but then exhaust the selling process first to make sure that you're going to achieve the price that you set out to achieve, and that you can know and understand your budget in terms of your onward purchase, and you can still make it work. In terms of what you can do to ensure that you sell and you get a result as quickly as possible, obviously we're Fine and Country, we deal with the upper quartiles, beautiful properties. Three of the things that we pride ourselves upon is presentation, exposure and service. So presenting the property in the best possible light is critical in this day and age. And that's making sure that you've got beautiful photography, videography, and it really sells it in the best light, and it sells the lifestyle that comes with the house. And also, you want to expose it to the largest possible market. Your buyer could quite literally come from anywhere in this day and age. We're seeing this massive increase in digital nomads where people can pretty much sort of dial into where they work from, no matter where they are. I'm coming from home today. I would imagine there's a few of the people on this call that might be doing the same, and they might spend a day or week in the city, a day of the week in the city. So remote working is quite a big thing. So that exposure is critically important. But the number one factor for making sure that you're going to get the best price for your property is to price it properly. And there are so many people where I see they over exaggerate their asking price, and actually what they end up in is this trapped by death by 1,000 cuts, where they'll end up taking little bits off and they'll permanently be chasing the market. The best prices are achieved when people come in and they price sensibly in the first instance, because that first 2 to 4 weeks are critically important for getting people competing against each other. And I think there are a lot of buyers that are very suspicious of things that don't sell straight away. They automatically assume that there must be something wrong with it, otherwise it would have sold. And you know what? It could only be 5 or 10% above what we would perceive to be market value, but that's enough to alienate buyers. And you might have got away with it 20 years ago. In this day and age, the consumer has access to so much more technology that they can verify whether it is the right price or whether it's too high, or look at comparables themselves. So I think pricing sensibly is really important for getting the best price and selling quickly.
Brilliant, really good advice there, thank you. And on to Chris then. So John touched on it, you know, do you find the property first or do you sell your property first? And in the event that somebody does find a property, is there a possibility to raise short-term lending against the property in the UK to use as a deposit on an overseas purchase?
Yeah, so absolutely, and going back to what John mentioned, that there are still a lot of US clients moving to the UK, but what we've also seen a significant movement in over, say, the last probably 12 months is clients that own UK property that are looking to sell or refinance, but then move overseas or have a base overseas. We're not seeing people just keep assets in the UK now. And a really good example of a case, typically my clients like to come to me, you know, I think it was the 23rd of December. This chap came to me in a mad rush saying, I'm buying a place in Switzerland. I'm moving over to Switzerland now with my family, and I've got 2 properties in prime central London. Now, the equity was going to fund part of the deposit for this property. So the issue is, as you've got a slower moving market, and again, it's about finding the right the sale price. This client didn't want to then do a kind of fire sale and just suddenly sell and dispose of those properties and take a massive hit on the sale value. So what I was able to do is raise short-term lending facility for, say, a year against the 2 properties in the UK, raise enough funds to be able to then take those funds overseas to be able to then complete on his purchase on the first week of January. So a very quick solution, and it meant that he didn't have to then suddenly sell the property very quickly. So again, this is a typical case that we're now seeing, with clients just giving themselves a little bit more time, not having to rush things, and just be able to financially plan a lot better.
Brilliant. And if somebody, one of the questions that I've got here is, if they're selling their UK home to fund a deposit on a property overseas, but they also own another UK property that they plan to keep, can they take out a long-term mortgage on that property?
Yeah, so this again is a case that we see quite frequently, where a client has a number of properties in the UK, and maybe they don't want to completely remove their footprint from the UK. They might want to keep, you know, sell their main residence, but they might have a buy-to-let or a second home property in the UK that they either continue to let out to get some UK income still, or they just want to have a base in the UK still to be able to use when coming back to the UK. Again, as John said, you can have this sort of digital nomad where clients like to have almost properties in every country now, so you can just float between. And again, when you're then resident overseas, it can be a little bit more challenging to get a mortgage if you're no longer resident in the UK, and you need to be able to demonstrate affordability if you're keeping a second home in the UK. And then you're resident overseas. We have lenders available to us, and we really operate on that open market. We're a little bit different from your standard brokerage, where we have lenders that are not worried about clients that are resident overseas or paid in a foreign currency. So we can then demonstrate the affordability to raise funds against the property in the UK to be able to, again, move those funds overseas to help towards lifestyle costs or purchase overseas or anything like that. So we can be quite flexible. And then in terms of the longer term element, as long as we can show the affordability, either from rental income that will be securely earned by the property in the UK, or if the client's got enough wealth or income, we can demonstrate that they can sustain that mortgage in the UK for a longer period of time. And then it just helps them pull that liquidity out the UK while still having a base there.
Brilliant. And typically what sort of loan to value can individuals expect to achieve via short-term and long-term lending?
So by longer term lending, if it's a residential basis, then we could gear up to, say, anything from 85 or 90% loan to value against that property. That just really maximizes the liquidity they can then pull out of that property to then, again, maximize that purchase price overseas. Especially with certain areas in Europe, you might be looking to buy, higher value properties. So it's important that we really extract as much lending sometimes out of the UK so they can really build that footprint overseas. And so on a residential basis in the UK, looking at maybe 85 to 90%. If it was a buy to let property, 75% is typically the maximum within the market, sometimes a little bit higher, but again, it's down to the strength of the case. And then on a shorter term facility, and again, as we go back to the case that I spoke about, often we can do rolled up interest, so a client doesn't actually need to service the loan for the period of the time that they have outstanding, meaning that the loan amount and then the interest that is accumulated then over the term of the facility and fees can all be repaid out of the property sale proceeds. Again, which means that the client doesn't have to maybe remit funds back to the UK if they've started earning overseas. And then loan to value, we would be looking at on a shorter term facility, gross with rolled up interest, you're looking maybe between 70 to 75%, and that usually provides a net borrowing amount of somewhere between 60 and 65%.
Great, thank you. And country-wise, can you help people get a mortgage pretty much anywhere, everywhere, or are there particular countries that are harder to get mortgages in?
So this is the interesting question. It's been amazing just to see over the last year where people are raising funds from to then go and buy. And we have got, I've got Barbados at the moment. I'm looking at clients that are looking to buy a second home in Tokyo, a lot in the Middle East. So Stuart said you were getting a huge shift towards UK clients going out, even celebrity clients now looking to go out to the Middle East just because sunshine, tax relief, etc. is just a massive pull, but also Europe. So in terms of, that's where we're seeing people move to, where we can get lending. We have a very strong presence in Europe. We're looking probably about a minimum loan size of around €1 million, just because within the broker space, it's the private banks that will mainly interact with brokers, so it's often a minimum sort of loan size of €1 million, but pretty much anywhere in Europe we can assist. Again, we've started doing a lot of lending in Dubai, so that's been kind of a really good proposition for us. If you're looking to buy in Dubai, you could be looking maybe 85% loan to value if you're resident in Dubai, or 65% loan to value if you're not resident in Dubai. Europe is typically you can get 100% loan to value as well, which is great, but then you do have to park, maybe between 40 and 50% of the loan amount under management with the bank. But the plus side of that is your funds are then not tied up within the equity of the property. It could potentially be put into an investment portfolio and earn you a return. So that's quite an attractive proposition for clients, and where it's important that we again raise money to be able to maximize that footprint overseas. And then the Tokyo one I'm looking at is 60% loan to value, second home. They'd spoken to everybody else and couldn't get lending there. So and also, again, going back to what John said, we've got a lot of clients coming to the UK, but also when we've got clients that are staying overseas in the US and then buying maybe in the UK or buying in the US, we can help get lending anywhere, typically up to about 80% loan to value. So yeah, we do have that global presence, and yeah, we're always looking to expand that.
Brilliant. And typically with the loan to values that you mentioned, is that for properties, I mean, does that apply to properties that haven't been built yet? If somebody's looking to buy and invest in off plan properties, is that a similar kind of loan to value ratio?
I think you'd probably find, same with the UK really, it's moving on to the development and bridging. We can still look to do that typically in Europe. Loan to values, when you're looking to, if you're buying a new build, it's not as bad, but when you're looking at sort of developing property overseas, you can start off with lower loan to values just because there's a bit more risk to the bank, and then you can start to draw down additional funds as well in tranches. But yeah, we can look at new build or existing, can be quite flexible in that regard.
Brilliant, thank you, Chris. Let's go to Jake next and have a look at some of the tax questions that we've got. I mean, Jake, I don't know if you've got a view on this, but one of the questions is, where is the most efficient place to move within Europe when it comes to estate planning? Oh, we can't hear you, Jake, for some reason.
Sorry, I was on mute. Yeah, there we go. So every country in Europe is going to be different. There's a lot of countries where there's no inheritance tax. So Austria, Cyprus, there's no inheritance tax in Portugal, but they potentially have stamp duty of up to 10% depending on the asset and depending on who it's passed to. Italy is only 4% for direct family. France has a spousal exemption, which means you can pass assets between spouses without an inheritance tax, and then the tax would then be on second death of the married couple. It's the same as the UK. And then Spain, there's certain regions, for example, where I live in Andalusia, you've also got Valencia, Murcia, Canary Islands, Balearic Islands, Madrid. All of these places have a 99% allowance on the progressive inheritance tax rates in the country. There is also an allowance of $1 million without any inheritance tax. So that though is only part of the solution, because Europe works off of civil law. So this is different to places like the UK and the US, which works off of common law. And civil law means there are what's called forced heirship rules. So this means your assets are distributed depending on your family structure. So take my family as an example. Me, my partner, 2 kids. A third definitely goes to the kids. Another third goes to the kids, but my partner has a life interest in that, which means if it's a property, for example, she can still live in the property. And then the other third goes to whoever you want, which is generally spouse. So it very much favors the kids as opposed to the spouse, which can create, quite a few complications and possibly arguments later on down the line. But what Europe does offer, it's something called succession and regulation, and this means you can use a will in the country of where your nationality is. So if, for example, you want to have a will in the UK or the US, which is common law, you can still do this, but it has to be set up properly. So it has to adhere to local rules. You can't just have a UK will or a US will and think, right, that's enough. It has to be structured and set up so that it is approved in the country of where you're living. And this is really beneficial because then you can do what you want, because coming from the UK or from the US, you can basically distribute your assets however you want. You can be as flexible as possible. And that is important because in Europe as well, because it is these civil law rules, things like trusts are not recognized. So this means if you do have trusts set up, you want to try to close these down before you move to Europe. What Europe does do though, because if you're a European living in Europe, then there needs to be ways to bypass some of these forced heirship rules. So there are products, insurance products, which often allow you to distribute your assets wherever you want. And these products are also available to expats. So countries like Portugal, France, Italy, Spain, they have these products they're tax efficient. So from a taxation point of view, whilst you're living, it's much more efficient to have a product like this than just a normal investment account. But it also means on death, you can distribute your assets and be very, very particular with how you want these to be distributed. It can also create some additional benefits depending on the country. So in Spain, just an example, the beneficiary is the person that pays the tax. So if we set up one of these insurance products in a tax neutral country, so not in Spain, and then the beneficiary lives outside of Spain, then it could avoid inheritance tax completely. So there's a lot of things. It very much depends on the actual situation of where you're living and what you're trying to do, but there is a lot of planning that can be done.
Okay. And I think a lot of people on the call potentially are looking at leaving the UK. They want to make sure that their assets and HMRC does not consider them domiciled in the UK for inheritance tax purposes. Are you able to just give us a bit of an overview on that front and what needs to be done to protect individuals?
Yeah, so domicile status, if anyone's not aware, it's effectively what would happen on death, i.e. you're paying inheritance tax and where are you going to pay it. It's different to tax residency and it's different to citizenship. The tax residency is where you're actually paying taxes physically, and in the citizenship, you could have multiple citizenships, i.e. multiple nationalities, but you don't necessarily have to be domiciled based on where your citizenship is. So to explain this a bit better, in the past, your UK domicile status was based on your father's nationality, if your parents were married, and if not, it was based on your mother's nationality. It was very, very hard to cut ties with domicile status. And if you did end up becoming a non-dom, and then you move countries, or even if, let's say you're living in the States and you moved, living in the US and you move states, it would reset back to the UK. So you've gone from being a non-dom to now being UK domicile again, and then being potentially liable to UK inheritance tax, which isn't great. It's 40% flat rate. There's no progressive rates at all. And you only have an allowance as a non-UK resident of £325,000. If you are a UK resident, you get an additional rate, which is called the residential nil rate band of £175,000. But as soon as you leave the UK, your main residence isn't in the UK, so you lose that. And this has been frozen for years. It's not a lot of money, £325,000, and anything above that per individual is 40%. So ways to avoid this, of course, we want to try avoid this as much as possible. But the good thing is they made it much more simple for people that are leaving the UK and are UK expats. So I'm very happy with the changes that they've made because it's affected me in a positive way. So now, if you're outside of the UK for more than 10 consecutive tax years, you no longer pay UK inheritance tax, you only pay it on your UK-based assets. So assets outside of the UK, no inheritance tax, assets in the UK, inheritance tax. And this could be one of the reasons why Chris said a lot of people are selling their properties in the UK if they're living overseas, because they are potentially going to avoid having a huge tax bill. And the easy wins there are things like bank accounts, investments. If you've got like national savings set up, for example, or premium bonds, things like that, sell those, move them outside of the UK. The things that are more complicated are property and also pensions. There was changes in the budget, not last autumn, the autumn before. That means as of 2027, UK pensions are going to fall under your state for inheritance tax. That was a bit of a kick in the teeth because everybody has always saved their money in a pension to avoid the UK inheritance tax rules. And they always go after pensions because it's an easy thing to do, because it's sticky money. You can't just make a decision to move it somewhere else. There was an option before of transferring into a Kairos, but they've pretty much closed that door completely. So the one way you avoid that within property and pensions, if you are going to leave them in the UK, is you use the spousal exemption, which I mentioned earlier on. So you can nominate, if you are married, this is of course. If you're not, then there's no real way around it. But if you're nominating your spouse, there's no inheritance tax until the second person passes away. So that gives you a lot more time to be able to make a decision if one of you has passed away. And Jonathan mentioned as well, people move back to the UK quite regularly if they are living overseas, and one of those main reasons is one of the partners has passed away. So it could mean that, for example, if you are a non-dom and you end up going back to the UK, the rules in the future don't really matter. Some other things to consider though on this 10-year rule is it can be broken earlier. So countries have something called a tiebreaker, and this is a tiebreaker of which domicile status is superior between the UK and the country where you're going. So one real simple example, in the US, if you're UK domicile, you move to the US domicile rules are much more superior than the UK, which means you could end up becoming a US domicile within a couple of years, which means you don't have to wait 10 years. Another thing that can be done is you can buy direct UK gilts. So UK gilts are government bonds, and these avoid UK inheritance tax from day one. So you've just left the UK, you buy these on the first day, you pass away the next day, all of these assets are protected from UK inheritance tax, and they are actually UK investments. And the reason I've done that is just to try to get more money in for the government, to try to increase spending. So it's a good way to do that, I think. yeah, that's sort of the general outlook of how to do that. Long story short, get whatever you can out of the UK, and just make sure you structure things offshore. And by offshore, I mean in a place that's tax neutral.
Brilliant, thank you. A lot to take in there, and I'm sure lots more questions are actually off the back of it for those in that position. I want to pick your brains a bit further, and I'm sure I'll come back to you as more questions come in. But Matthew, I'll come to you quickly to talk about the moving of money. So of course, with buying or investing abroad, there is going to be a currency exchange somewhere along the way. I mean, what's the difference between using a currency specialist like yourself over a bank?
Yeah, well, that's one of the main reasons we exist in the first place, because typically banks don't offer very competitive rates of exchange. We do close to £10 billion worth of currency through this dealing desk every year. It's about 30-40 million pounds a day. So that means that it allows us to buy a much more competitive rate from our providers. We mystery shop banks to help understand the average rates and fees associated with exchanging funds, and on average, you can expect a saving of about £500 to £1,000 per 50,000. So when you're working on much larger volumes of funds, you can see how that difference becomes a lot more apparent. It becomes a lot even more apparent when you start looking at the difference in currency movement. So sterling US dollar is a great example of that. There's been an enormous amount of movement on that over the past year. It's gone from about 125 to about 138. So that's an extra 10% difference in the exchange rate. So if you're looking at, £500,000 to US dollars, that's a difference of about $65,000. So it's a huge amount fluctuation, especially if you're looking at buying a 4-bedroom property or a 5-bedroom property. That's the kinds of difference you're looking at. So we can't offer advice or tell you what to do or what is going to happen. It's really to offer the experience that we have and guidance, as well as the expert market information that we have, to help you make more of an informed decision, as opposed to just going in blind and exchanging your funds whenever.
It may be that, I don't know what your advice is, but if somebody wants to move money in advance of finding a property that they want to buy, are you able to kind of help them planning before it gets to the point of needing to make a purchase?
Yeah, of course. I mean, the whole point here is to time that exchange so you're doing it at the right time, not just when you need it. Essentially, what you have here is a free multi-currency account where you can send and hold funds, and we'll initiate payments when you're ready to do so. We're what's called an e-money institution, so that means that we're able to hold funds for you for as long as you need, and your funds fully protected for the entire duration. That's a method called safeguarding, where we place your funds in a segregated account, and that protects you from creditors if anything happened to our firm. So yeah, if you are concerned about the rate, you can preload your account with currency you'd like to exchange, and we can discuss the timing and everything ahead of the future payment. But yeah, there's no fees for setting up the account or just having a conversation with us if you just want to chat and see what we can do.
And is that the case as well? If there's not a destination account finalized yet, you can still help individuals manage that process?
Yeah, exactly. So you can keep the funds here. We can talk about some of the different contract types that we can offer, and then eventually, when you get to that point, we can either send it to your destination account or to a notaire or solicitor from there.
Brilliant, thank you. Just looking at some of the other questions that have come in, and I think, Chris, this one's going to be one for you. How can we raise a mortgage on our UK-based limited property company?
So if you have a property or multiple properties that are owned via a company structure, and this can be via either a UK company or an SPV that's based in most jurisdictions internationally, we can look at raising lending via either a single asset, or we can do what we call a portfolio refinance. So we can have one lender or multiple lenders secured against the entire lending portfolio, and we could gear that portfolio anywhere up to about 75% loan to value, and then we can utilize those funds often people will then go and purchase another property within the structure, so they don't have to extract the funds from the business. But again, we could get lending that you could then withdraw from the business to utilize elsewhere. So that is quite a common scenario. And again, with UK tax changes, while we don't give advice on tax, we often see clients now buying properties within a company structure just for tax planning and future tax efficiency.
And that leads into a tax-related question for Jake. How can you avoid capital gains tax in the UK on worldwide sales?
So I'm not sure if this is as a UK resident or as a non-UK resident, but it depends on the asset itself, because there are certain structures that you can do within investment products. So for example, with an ETF or a fund, there's two different options that you can buy. One would be distribution and one would be accumulation. So distribution would be where, for example, things like dividends tax are paid out, but accumulation would be where it wouldn't. And then what you can do is you can just make sure you hold this asset for as long as possible. There are different strategies in different countries where we can do things like tax loss harvesting. And this means that we can buy multiple securities. So securities are just things like stocks and bonds. And we can sell particularly securities at a loss to offset against gains in the future. And this could mean in 1 year, for example, there's 15% of gains, but we've recorded a 2% loss because we've sold more assets at a loss than ones that are at a profit. And then we're just utilizing the different allowances that are available in the country of where the individual is living. So that's just a few different examples, but then it's also about utilizing different products, because capital gains, for example, in the UK, the allowance has gone down significantly. Other countries don't have an allowance at all. So in Spain, you're literally taxed on the first euro that you earn. So it's looking at different products which maybe are more tax efficient and will be taxed a different way, because that way you're not just looking at capital gains, you're looking at capital gains, dividends, tax on interest, income tax, or even just different products which allow you to have a tax deduction on things like capital gains.
Okay, and then just in terms of, I'm just conscious of time and sort of wrapping things up with you, Jake, first of all, what would your kind of final bit of advice be? I mean, if somebody's looking at buying or investing abroad now, I mean, what sort of things should individuals be considering from a tax perspective? And is there anything else that you think is worth mentioning that we haven't covered already?
Yeah, so there were a lot of questions surrounding getting my money out of the US or getting my money outside of the UK. What we do is we don't invest clients' money in the country where they're living. So if you're living in Spain, we don't invest your money in Spain, we don't invest your money in France, we invest your money in a tax neutral jurisdiction. And what tax neutral means, it just means a country where there aren't taxes. So there's no inheritance tax, there's no withholding tax, no capital gains tax, no dividend tax. So these are places like Ireland, Luxembourg, Channel Islands, and this just means it's very straightforward for someone that is moving overseas, because it means you only deal with taxes in the country where you're living. So it's not tax evasion at all, it just simplifies things completely, because if you do move country, then there is a potential that you end up moving somewhere else. And the last thing you want to do is end up being in a situation where your money's in a country that isn't going to be compatible to the new country of where you're going. It's also important not just from the product, but also the underlying investments. And this is more important for Americans than any other nationality, but it is also important for Brits. So for Brits, for example, it's very straightforward. Do not buy any funds or investments that are UK domicile. And the way you can check this is a particular codes. They're called ISIN numbers. If it starts with a GB, it's based in the UK. You want to avoid that because, as I mentioned on the inheritance tax side, it just brings it under the UK inheritance tax. For Americans, it's more complicated because if you're buying a non-US ETF or fund, it's classed as PFIC, which stands for Passive Foreign Investment Company. And this means on the gains, it's not capital gains, they pay tax at their ordinary tax rate at the highest bracket. So it's not tax efficient at all. And then if they're outside of the US, if they were to buy a US fund or ETF, they pretty much can't do it, because Europe, for example, has completely different reporting rules and information that has to be shared to retail clients, which means that you pretty much can't do that. So even using like the main US custodians, so Fidelity, Schwab, for example, if you update your address and you're now a non-US resident, you actually can't buy funds or ETFs in most European countries. So it just means you're stuck with a strategy of direct stocks and direct bonds. So every country is different, and it's one of those scenarios where we need to sit down and explain those. The best case scenario is doing this way before you move. So not 3 months before you move, because our onboarding process can take normally between 4 to 6 months. And there's a lot we can do before someone's actually moved. And we need to take into account the different, where they're going to be a tax resident, because if they're in the UK or in the US, it's often better to do things there. Because if they've already moved, then we may have missed out on opportunities of what we could do with their assets at the moment. And we can structure those a lot better before they actually make the move.
That's really good advice. Really interesting. It can take that long a period. I didn't realise. So thank you, Chris. Any final thoughts from yourself, or any questions that I haven't asked that I should have asked?
One thing I would say, we always talk a lot about people moving overseas, or changing and building a kind of asset base on a global scale, and not just having assets in one jurisdiction. Now, I think before you're going to make any huge life decisions like this, I think speak to everybody that is on this call, because it is so important to cover every area before you go and do these purchasing a property or transferring funds overseas. Looking at things from every kind of different perspective, because things change so frequently now. I think it's just never been more important to make sure that your financial planning is done correctly before you then go and buy assets, etc. So yeah, I think that's my advice. Get the right planning.
Thanks, Chris. Stuart, over to you.
Yeah, Chris has stolen my thunder. I was going to say exactly the same thing. You literally do have a one-stop shop here where you get every solution looked at. But from my perspective, from Henley and Partners' perspective, once you've found your property via Nikki and Jonathan, once you've sorted out your structures via Jake, once you've got your lending via Chris, and once you've moved your money via Matt, the one important thing to think about from Henley's perspective is that just because you've bought a house in another jurisdiction, it doesn't mean you can go and live there. And that's really key. You have to have, you can spend time there, of course, on a visitor's visa, but if you want to actually relocate, you have to have the right provisions in place, and that's where we come in. And even if you're looking to buy a property in another jurisdiction, maybe to holiday there for 6 weeks a year or rent it out, why not use that asset as a way to obtaining another residence and citizenship also? It can be looked at both ways. But just because you buy a place in Portugal or just because you buy a place in the UAE, it doesn't mean you can go and live there. That's where we come in, once we've spoken to everyone else as well.
Yeah, excellent. Thank you. And Matthew, from your perspective?
Yeah, I think the only thing I hadn't spoken about was just the different kind of contract types, and that does feed into a lot of what Chris and Stuart have said in terms of planning ahead. So one of them, forward contracts, where if you're looking at the price of a property, you just need to understand, how much you'd be paying in the currency that you're selling. You can actually buy that currency and we'll hold the rate for you. So it means that you don't have to scramble around having to get all your pounds, for example, ready to go. You can essentially freeze the rate. You know what you're going to be spending on that property, because you see it happen so many times. As I said, over the past year, the fluctuation of about 10%. You can avoid that by doing those type of contracts. So yeah, getting in touch with a currency broker just to have an understanding of what your budget actually is in that currency, and then having some control over it. That's something that was typically now is something that a lot of people who are leaving the UK will look into, that type of contract. So yeah, that's definitely what I'd recommend.
Definitely, that's great advice. Thank you. And Jonathan?
Yeah, just to echo the sentiments of everybody on this call as panelists, speak to the specialists. You know, from our perspective as agents, don't rely on property portals. They'll give you a snapshot of what you can buy, but you need to understand the nuances of the different markets in terms of where's a good place, where's a bad place. You know, a property might look attractive, but it might be in the wrong location. And there's a hell of a lot that we deal with in this day and age that's off market. You know, we've had a mandate today on a place on Lake Como for 100 million euros, and it's not available publicly. But at the other end of the spectrum, we've got things at €1 million that aren't available publicly, and the agents on the ground will be able to connect you with the right properties that are suitable for your needs. So I think portals can be a dangerous place for property searches. An agent will steer you in the right direction.
Brilliant. Thank you so much, guys. I think the common theme is planning, getting advice, working quite far in advance so that you're making the most of your money, making sure it goes as far as possible. And the guys on this call can certainly help you with all those, with every single angle. So once again, the email follow-up will include everybody's contact details so you can reach out individually. And before I dial off, there is an opportunity to meet the guys on the call face to face. We've got a live event taking place on the 28th of March, where we will have various different countries featured with properties, and so you'll have the opportunity to interact with agents on the ground in different countries across the world that you're potentially looking at buying in or investing in, and the guys on the call here will physically be there as well to answer any questions. So 28th of March, and in the email follow-up you'll get all of the information through in terms of location and timings, etc. But thank you so much everybody, thanks to the panelists for giving up your time, really valuable. I mean, what a lineup of individuals. Thank you so much for giving your time and sharing your expertise and experiences. It's been hugely valuable, and thanks everybody for joining and submitting your questions in advance. Hopefully we've covered as much as we can, but please do reach out for your individual advice. But otherwise, thanks all, and over and out.
Thank you. Bye.
Bye.
Thanks.